Welcome again to another session of this video on IFRS 16 lease. If you have not watched our previous video, please do so and help us to subscribe on this channel. It's important that you subscribe so we can keep serving you better. In the last video, I told us that the video that we'll be doing next will be very much comprehensive. We'll take you through the step by step as to how to handle calculations under IFRS 16 lease, the accounting treatment, and I told you I'll be giving the step by step approach. So very quickly, let's run through what we will be doing, the step by step approach. The step one, whenever you are computing, this accounting for lease. I told us before now that the accounting that we are doing is for a single book of account of the lessee. The lessor do not need to prepare any account. Why? Because he has relinquished the control that he has on the asset. An asset, for you to call it an asset, you must have control over the asset. That is the right to use the asset to generate future economic benefit. But since you have relinquished that right to the lessee, the lessor do not need to prepare account as it were. So it is the account of the lessee that we are going to prepare. And that's what we are looking at. We have looked at an illustration how to determine the initial measurements of that is calculating the initial measurement of the right of use of asset and the lease liability. So quickly let's run through the accounting treatment for this in the book of the lessee. So the accounting treatment, and that's what we are looking at here. Number one, the step one is you must always the step one for you to be very fast. When you see an exam that say you compute the accounting treatment for lease, the step one is that you must always prepare your statement schedule. Put down your statement schedule. Put down your statement schedule. What do I mean? Put down your statement of financial position, that is your statement of financial position, as well as your statement of comprehensive income or profit or loss account and other comprehensive income, whether it is arrear or it is an advance that the lease payment was made. This is what you will end up putting. So first of all, put this down in your answer booklet. And what do you put under them? Under the statement of financial position, put down your non-current asset. Under your non-current asset, put down right of use asset that you will always get in your working. So you put it down. Right of use asset. Then you close it. That goes like that. Then you now have equity and liability. Equity and liability. Under here, we put down what we call under the non-current liability. We really put down this liability, and then under the current liability, you put down another lease liability. Now, let me quickly explain this. There's what we call the amortization schedule. In that amortization schedule, it will help you to know the lease liability that you are going to bring here, as well as the lease liability that you are going to bring under the current liability. Also, under the amortization schedule, it will help you to know the finance charge you are going to charge in your statement of comprehensive income. I'm bringing that now so that it will be more simple for you. When we get to the workings, you will understand it better. So just quickly run through this one, and that is that. For that, you close it. That will give you the statement of financial position. Then the second one is the statement of comprehensive income. Under the statement of comprehensive income, you have what will come here. You just put it down. Depreciation will come. You put it. Finance charge or finance cost will also come. Finance cost. I don't know if you are seeing here. Finance cost will also come. So that is these two items that are always in your statement of comprehensive income. So whenever you see a question, just first of all put this down there. Now go to your workings. You go to your workings. It's important that you follow these steps as I am just following them through. Please follow them as I'm following through, and then we'll have a good time together. So that is that for that. Okay, so let's quickly run through the workings now. Let's run through the working. Under the workings, sorry, I'm going to use red now because my marker they are printing. Under the workings, you have the first step first. The first thing first you are going to determine under your lease payment. The first step is to determine your right of use asset. That's the first step first. You understand me now? And in determining your right of use of asset, I've always told you the first is the sum of the present value of lease payment, whether in arrears or in advance. You add direct initial cost less incentives, because it will always be net cash that will be had, and then you have what we call if there is a lease payment. For instance, if you are calculating under advance now, you will add it lease payment that was made, lease payment, and then present value of dismantling or restoration cost. I've told us about this one in our first video. You can go and watch it to have more understanding. So all of this will be the total of your right of use of assets. So first of all, determine it. And I told you how to determine your present value of lease payment. Instead of doing it 1, 1, 1, if they give you 5 years, 10 years, instead of doing it 1, 1, 1, just use the annuity formula, which is present value is equal to A1 minus 1 plus R minus N raised to power R, like this. Very simple. Once you put it, you get your value depending on the number of years. So please, that is that for that. The same thing applies here. If they give you dismantling or restoration cost, is the same thing. You will discount it. Present value is equals to this same thing here. You will discount it in that. But you know that one now, you're not going to use your annuity for this one. You're not going to use your annuity for this one. And what? Let me state it categorically now. You are not going to use annuity for present value of dismantling or restoration cost. Why? Because it is the amount that you are going to spend in the future that you are discounting into today. You understand? For instance, under the lease payment, it is a spread, a cash flow. What is flowing for first year, second year, third year, fourth year, fifth year. But for the dismantling or restoration costs, it will be maybe at the end of the lease contract. So if it's at 5 years, all that you need to do is just to find a brand. You get your discounting factor by just saying 1 plus R raised to power minus N. You understand? Whatever you get there, you multiply it by A. A is the amount that is here to give you the present value. Let me give an example. Let's assume that the dismantling cost will be 100,000, and then they give us the rate to be 10%. So what you need to do is just to do 100 multiplied by 1.1 raised to power, and they said this lease payment will end in 5 years time. 5 years time. So if it is this 5 years time, just put minus 5. You punch it. Let's punch it quickly. So that will be 1.1 raised to power minus 5 to give us 0.621. 0.621. That is what this one will give to us. 0.621 multiplied by 100. Multiplied by 100 means that the present value as 100 multiplied by this will be equals to 62,000. That's how simple it is. Please, they don't usually put this dismantling and restoration cost, but they may put it in the exam that you are going to write now. So please, if they put it, this is how to just go about it. It's as simple as that. Please understand it like that. It's as simple as that. So let's quickly go. The second step. The second step is you determine. Second step, this one now, is our, our right of use of asset. Whatever you get here, you bring it here. You bring it here. Then the second step is determine depreciation. Determine depreciation. Depreciation. And your depreciation is always going to be whatever value you get here. That is the right of use of asset. The right of use asset divided by the number of years that the contract is going to stay. It will give you your depreciation charge for each of the year. Give you your depreciation charge for each of the year. Whatever you get there, you bring it here. So that will be your working stool. Then the third one, the third step is you determine the subsequent right of use of asset. Right of use asset subsequent carrying amount, which is very, very simple. It's just this right of use of asset. That is your step 1 minus your step 2. It will give you the carrying amount. Or if assuming we are going to do 1, 2, 3, 4, 5 years now, this one is only for 1 year. That is when you will do this step 3 to get your subsequent measurement for right of use asset. What we are saying is this: subsequent measurement of an asset. It's not either you use cost or evaluation model, but for lease you use the cost model. And that will always be your what? Your cost. That is this initial cost here, or initial right of use asset valuation that we got here minus accumulated depreciation. It's as simple as that. Then the fourth one now, the fourth step now is to determine your lease liability. Determine the lease liability. Determine the lease liability. That is the third step. That is how to do it. Determine your lease liability. And I told you, determine your lease liabilities. Everything. Use your amortization schedule. The amortization schedule is very, very easy. Amortization schedule is very easy and very fast. It's very easy and very fast. So all that you need to do is you put your schedule like this. You put the year here. Then you put you put your year item. You put or let me put it well. Opening balance. Opening balance will be here. This you have finance cost here. This one will always be in the percentage. That implicit interest that is given to you, or incremental borrowing that is given to you, that is what you will use here. Let me also state it again in case you have forgotten that if you are giving implicit rate and at the same time explicit rate in your questions, don't use explicit rate, use only implicit rate. And where they give you explicit rate and they say there is also an incremental borrowing rate, don't use explicit rate, use incremental borrowing rate. Please don't forget that. That is that for that. So you have opening balance, your finance cost, and then you have the lease payment here, and then you have the closing balance here. Now let me do it this way so that you will understand. Your year is always your year. Opening balance, let's assume this is 1, 2, 3. Your opening balance will be this right of use asset that you will get here, or when you minus all the cash item from it, it will give you your opening balance. Most of the time, it's always when you determine this lease liability. Where is it? When you determine, okay, I've deleted it under remove it from under this determine of right of use of asset. That present value of lease payment, that value that you always get there, that's what you will bring as your opening balance. It will be here. Then you will charge this finance cost on this. Let's assume this is A, this is B, this is C, this is D. B now will be equals to percentage multiplied by A. The interest rate that is given to you multiplied by opening balance that is here. That is what will give you this one. So, then lease payment will always be given. They will tell you the payment is 100,000 naira every year, or they will tell you the payment is 50,000 naira every year. Whatever they tell you, we will put it there. So that is that for that. So we have C now will now be, it will be given. C will always be given. Then your closing balance will now be equals to C. D now will be equals to A plus B minus C. That's what will give you your closing balance. It's very simple. This is how simple it is. Huh? So whatever you get here as your finance cost, you will bring it here as your finance cost. Statement of comprehensive income, you will bring it here, and that is what we hand it. You can see it's very, very simple. When we do illustration, comprehensive illustration, you have a better understanding of it. However, it's important that you don't just do these things anyhow. You do it appropriately. So when we take illustrations, you understand, like I said earlier, you understand it better. So thank you for watching this very own clip again. The next one we're going to do a comprehensive illustrations. Please watch out for the next video. Thank you for your time.